Chapter 11. Allocating Your Assets. Ever watch the cooking competition show Chopped on the Food Network? Each of 4 rival chefs has 20 minutes to whip up an appetizer. The judges chop one chef, then eliminate a second one after the entree round, and get down to the winner by dessert. Each round features a new mystery basket of oddball ingredients all the chefs must use, such as Rocky Mountain oysters, squid ink, fiddlehead ferns, or Buddha's hand, a fruit. Yet the chefs turn out an amazing array of dishes with wildly divergent recipes, using components in different proportions and different ways. Coming up with the best combination is what wins the $10,000 prize at the end of each show. The same idea applies to the lengthy list of types of asset classes in which you can invest. It astonishes me and disturbs me how most portfolios are overly invested in the usual suspects, stocks and bonds, either separately or tucked into mutual funds and ETFs, and lacking in so many other contrarian, non-correlated ingredients. It is wise to start adding these against-the-grain assets to your life savings, though the question arises, which ones, and in what proportions? This is what we call asset allocation. It is the key to good investing, requiring an understanding of the correlations among various kinds of assets, an acknowledgement that the world of correlations has changed, and the admission that what used to work doesn't work anymore. A lot of firms on Wall Street have fallen short in adjusting to this shift. See Chapter 7 on non-correlated assets. Should alternative investments compose 50% of your holdings, or only 33%, or maybe just 10%? Coming up with the right recipe for your mix of assets is an elusive black art and a mystery to most Wall Street firms. Your typical broker is likely to advise you based on the old saw about splitting stocks and bonds, based on the result of 110 minus your age. If you are age 50, then 110 minus 50 equals 60, so 60% of your portfolio should be in stocks. The portion in stocks goes down as you age because you have fewer years remaining for your depressed portfolio to recover from steep losses. That is a fine place to start. Though this split underestimates the upside power of stocks over the long term, and it fails to recognize that we live much longer than we did even a few decades ago, so we have more time for a rebound. You must go much further in constructing a sound portfolio. Yet everywhere I looked on Wall Street, I found all of us were operating without a real guide for doing this. Most of us were failing to weigh returns against the risk we were injecting into client portfolios, failing to reduce volatility and the range of possible outcomes, failing to brace our clients for the effects of the unseen increase in their cost of living, and failing to ensure our clients were adding off-the-beaten-path, non-correlated assets to their accounts. When I gave away most of my smaller accounts in the late 90s to focus on building my first bill, I joined an elite group of wealth advisors. My hope was they would possess a higher level of knowledge and preparation than the rank-and-file brokers, but what I found instead was more of the same. Certainly the vocabulary was more advanced for the advisors in this realm of the swells, as I learned when I started working on mergers and acquisitions at Morgan Stanley. Yet these higher beings in banking still possessed the same blind spots on COLA, risk, and volatility. None of them were following a set of well-tested guidelines for what kinds of investments should make up the typical asset allocation for which kinds of clients. Asset allocation was, like the rest of it, more of an afterthought. I saw the wider problem after I quit Morgan Stanley and joined Bank of America, B of A, months later, in early 2003. Upon arrival at B of A, I embarked on an introductory tour around the empire to meet with various luminaries, all of whom were knowledgeable and impressive, and every bit as vague on asset allocation as the rest of us on the street. At one point I flew to St. Louis to meet with one of the smartest people I ever have met in the investment banking world, Dr. Joseph Cherian, who at this point was at Bank of America Capital Management. He had a bachelor's degree in electrical engineering from the Massachusetts Institute of Technology, MIT, and a master's and Ph.D. in finance from Cornell University. A year or two after we met, he would take a job at Credit Suisse in New York to run $67 billion in alternative assets. How's that for a bill? He was one brilliant guy, and yet even Joe Charian didn't have some secret magical system for allocating assets and evaluating risk and volatility in a portfolio. He acknowledged the industry's silence on this issue, and I told him there should be some sort of formula, a way to measure all portfolios to determine how well they were serving their clients in terms of allocation and diversification, risk and volatility, cost of living increase, and more. There's nothing like that, he told me back then. That was my eureka moment, and it made me think that I needed to create something like that. You can rate your driver on Uber, rate a restaurant on Yelp, buy a washer-dryer with an energy rating, and scroll through Consumer Reports for ratings on thousands of products. Yet nowhere is there a cogent, consumer-friendly rating system for how we invest trillions of dollars in life savings for millions of people. Thus began the years-long creation of the CHIP score. At the time, Joe Charian and I were talking about the flaws of the Sharpe ratio, a financial metric for rating and comparing the returns of hedge funds that gets bandied about a lot by advisors talking to institutional investors. The Sharpe ratio often is used to compare two different kinds of assets with different rates of return, say an international stock fund versus a basket of utility stocks, to help the investor pick the one that offers a solid return with less volatility. The metric is applied to entire portfolios, too. At first glance, the Sharpe ratio seems to do a good job of assessing returns compared with the risks involved in earning them. Economist William F. Sharpe devised the ratio in 1966 as a simple way to compute this relationship between risk and returns. In 1990, he won the Nobel Prize in Economic Sciences for his work in creating the capital asset pricing model, which calculates an asset's rate of return against its market risk, compared with the expected return of a theoretical risk-free asset. To compute the Sharpe ratio, you start with an asset or fund's rate of return for the previous decade or more, say it is 10%. You subtract from this number the rate of return offered by a risk-free asset, usually 3-month Treasury bills, which lately have paid annual interest of 1.89%. So 10% minus 1.89% equals 8.11%. This is how much more in returns you earned by taking on the extra risk you assumed, above and beyond the almost risk-free rate on 3-month T-bills. Next, you take that extra risk return of 8.11% and divide it by the standard deviation of your portfolio. Say your portfolio had a standard deviation of 8 for that gross annual return of 10%, so that 95% of the time in the past decade, your results fell somewhere in the range of up 26%, 10 plus 8 plus 8 equals 26, and down 6%, 10 minus 8 minus 8 equals minus 6, finishing with an average of 10% in any given year. Now divide that 8.11% risk on return by the standard deviation of 8, and you get a Sharpe ratio of 1.01. Fantastic! A Sharpe ratio of 1 or higher is considered excellent, and wealth advisors make a big deal out of it when selling a hedge fund to their clients. They will offer you 2 hedge funds and tell you the first one has a Sharpe ratio of only 0.5, but the second one, take a look at this baby. It has a 1.2 Sharpe ratio. As if it has superhuman strength. It's the Incredible Hulk. So, if Mrs. McGillicuddy has a portfolio posting an average annual return of 4% with a standard deviation of 2, that would produce a Sharpe ratio of 1.05, it is supposed to be just dandy. Yet her portfolio is a disaster, because it is returning 4%, and she lives in Dallas, where her costs really are rising closer to 7% a year. She is falling behind at a frightful pace every year, and the Sharpe ratio gives her portfolio an excellent rating because it fails to take COLA into account at all. That is a prescription for a long, slow, imperceptible slide into financial suicide. Yet here we are, telling the client to take comfort in knowing her portfolio has a great Sharpe ratio. It is like saying, "These go to 11, as the vapid, gum-chewing lead guitarist Nigel Tufnell put it, spinning the knobs on an amplifier in the mockumentary This is Spinal Tap. It means nothing. Sharpe also fails to assess another risk to your returns, volatility, and the emotional and unwise responses that it can create. Volatility hurts in two ways. Once, when it causes an asset's value suddenly to plunge, and a second time when that plunge or the news of it causes an investor to do something stupid in response. The Sharpe ratio is better used for institutional portfolios whose managers have less emotional responses to volatility because they take what is happening to their accounts less personally. It is other people's money at risk. What about the individual investor, though? Somebody should devise an intelligent, sophisticated portfolio evaluation method for the little guy, a scoring system that will reveal whether your financial advisor is ensuring your asset allocation is optimal and your targeted returns will offset your higher cost of living. No one has done it. Yet. At one point some years ago, I gave a speech to 300 advisors at a Merrill Lynch gathering, and I asked those in the audience to raise their hands if they knew the definition of the Sharpe ratio. Maybe 40 people raised their hands. Then I asked how many knew what a good Sharpe ratio is, and 3 people responded. Merrill's literature talks plenty about the Sharpe ratio, yet clearly the firm does little to train its brokers in the details of it. Wall Street was failing to train its advisors in proper portfolio construction and asset allocation, so I turned my gaze to regulators. Maybe they were better positioned to gauge risk and ensure that Wall Street was following appropriate asset allocation guidelines and issue warnings when things got out of hand. So a few months before the great meltdown of 2008, I began researching what the Securities and Exchange Commission and the industry's self-regulatory body, Finra, Financial Industry Regulatory Authority, were doing to rein in risk, erect boundaries for safe asset allocation, and stop Wall Street giants from leading their lemming clients off a cliff. Alas, the SEC and Finra were doing little to nothing on this front. My research showed the SEC was focused on making sure Wall Street followed the rules, while Finra was more devoted to ensuring Wall Street didn't get sued or investigated by the SEC. Both agencies were silent on proper asset allocation and the right level of risk and how to quantify it. At one point, I went so far as to contact Finra directly. Someone patiently listened to my points about how they were clueless on these concerns. I offered to visit her and lay out how Finra should evaluate investor risk and set parameters for allocating assets in a portfolio. She told me to go pound sand, basically. Finra had no interest whatsoever in my views. This left me stunned and walking around in a daze for the next week. If the regulators didn't have a system for evaluating portfolio risk and asset allocation, why would the Wall Street wealth advisors under their watchful eye be able to understand it, much less their clients? This was a disaster waiting to happen, and it felt as though everyone on Wall Street was in on it. So many people in the business were faking it and getting away with it, perpetuating a lie that they had your back when they didn't, and everyone believed them, and we were doing nothing to fix it. I felt like a fraud. Around 2012, I had some key elements of my new chip score system in place, and I wanted to test them, so I went calling on the biggest names on Wall Street with a simple request. Please show me your model portfolios. I wanted to see how they approached asset allocation, by what formula they divvied up client funds into various types of vehicles. Fidelity Investments, J.P. Morgan Chase, Citigroup, Goldman Sachs, Merrill Lynch, UBS. The premier shops on Wall Street were proud to show me their model portfolios. I ran them through some of my new metrics: standard deviation, level of risk and volatility, how much money a portfolio could lose if enough things went wrong. The results stunned me. Virtually all of these supposedly safe, low-risk model portfolios were in fact geared to take on far higher risk and the possibility of far higher losses in any given year than any investor should find acceptable. The asset allocation of every one of the portfolios I inspected was aggressive in risk-taking based on historical rate of return versus standard deviation. Even the models labeled conservative were aggressive. Yet these model portfolios and asset allocations were constructed by the best minds on Wall Street. Unbelievable. The model portfolios were horrible. Some were described as low risk, yet nowhere was it disclosed as to what this meant. Some portfolios had a 26% chance of losing money in any given 12-month period, based on historical data. Some portfolios had a 26% chance of losing money in any given 12-month period, based on historical data. Nobody would call that low risk. Take a look at the numbers for these 4 model portfolios from 4 different financial titans, each portfolio based on a starting investment of $3 million in total. In most cases, they carry more risk and downside than advertised. The Morgan Stanley conservative chart can be found in the bonus PDF. When I reviewed the metrics for the conservative portfolio of Morgan Stanley, the numbers were pretty good, for starters. The Morgan Stanley conservative portfolio had a rate of return of 6.61%, and its standard deviation was lower than its average return, at 6.39. Recall that when it comes to STDs, the lower, the better. If you can get the STT less than your average rate of return, as is true in this case, it is great. The chart above lists a new metric we haven't yet explained, the variance drag phantom tax. I invented it, and we will go into the details of this metric in the next chapter. For present purposes, just know that the drag phantom tax is the ratio of your account's standard deviation to its rate of return, STD, divided by ROR, and it should be at less than 1.0. In this Morgan Fund's case, the VDPT is 0.97. That's good. The probability of producing a loss in any given 12-month period is restrained at 15%, my recommended limit, and the worst you can do likely will be down 6% or so in a year's time, a relatively low downside. The Bank of America Merrill Lynch moderate chart can be found on the bonus PDF. Merrill Lynch's moderate model portfolio, conversely, is all too risky. Its standard deviation should be at 80% or less of its average annual return, yet this portfolio has an STD of 12.6, 3 to 4 times as high as its annual return. This model's drag phantom tax is a hugely damaging 3.27, and the portfolio carries almost a 40% chance of running a loss in any 12-month period, way too high. Likewise, the growth and income portfolio for Goldman Sachs has a standard deviation at more than double its rate of return. It should be 4.8 rather than 15.2, which means it has way too much volatility. It also boasts a rather high phantom tax at 2.42, and a 1 in 3 chance of losing money in any given year. Plus, the maximum downside is steep, a loss of almost $900,000 potentially. The Goldman Sachs Growth and Income Chart and the J.P. Morgan Chase Growth and Income Chart can be found on the bonus PDF. J.P. Morgan Chase's portfolio for growth and income is even worse. Its rate of return, at 4.5%, is 28% lower than the 6.27% return of the Goldman Sachs portfolio, yet the standard deviation is even higher at almost 17, and so is the phantom tax at a daunting 3.7, when 0.8 or lower is an ideal score. Worse yet, the J.P. Morgan model portfolio boasts almost a 40% chance of posting a loss in any 12-month period, and the account could lose more than $1 million in a single year. Ouch! Always keep in mind, anytime we talk about a 40% probability of a loss in any given 12-month period, it always means a loss could happen 2 or even 3 years in a row. Loss, loss, loss. Enough to wipe out your life savings. Moreover, whenever I talk to the people involved with building and maintaining these model portfolios, nobody could even quantify risk. I reviewed the components of 3 different Fidelity portfolios, one labeled conservative, the second one deemed moderate, and the third said to be aggressive, and every one of them was higher risk than their labels would imply. Et tu, Fidelity? The gigantic firm has almost $7 trillion in assets under management for 27 million Americans, and it has a great reputation for safe, conservative investing. And even Fidelity approached clients as if they were fat cat whales at the baccarat tables in Macau. This surprising realization reinforced my disillusionment with Wall Street, and it showed me yet again that my industry was basically a big joke. This made me redouble my efforts to build a better method for evaluating portfolios and their asset allocation, and more importantly, a way to assess the performance of the advisors who designed them. The new chip scoring system I devised is the answer. And we are almost to the point where I reveal it. But first, a few broad strokes on the right asset allocation for your portfolio. In the old days, journalists used the inverted pyramid to guide the unfolding of their stories, with the biggest and most important elements at the top, followed by a succession of ever less important facts. And so it is with my inverted pyramid of investing, which sets out the big-picture boundaries of asset allocation. The inverted pyramid of investing chart can be found in the bonus PDF. To elaborate on the obvious, typically 70% to 80% of your total assets should be in public securities, stocks, ETFs, mutual funds, and bonds if you must, though bonds almost always lose purchasing power amidst a rising consumer pricing index. Shoot for a return of 10% per year so as to double your money in 7.2 years, thanks to the miracle math of compounding. Next up, alternative assets for non-correlation purposes, to even out the wild swings of the stocks in your portfolio. Park 10% to 20% of your money here, with the expectation being one of non-correlation rather than a net upside return each year. The liquidity line separates the readily accessible assets at the top of the inverted pyramid, public securities and alternatives, from other investments at the bottom, which lock up your money for years at a time and therefore are illiquid and unavailable. In terms of what should comprise the alternative assets that occupy up to 20% of your portfolio, my recommendations break down as follows. Real estate, 7% to 12% of your portfolio for non-correlation to stocks. Private equity, 0 to 5% of assets, with the goal of tripling your returns in 5 years. Venture capital, 0 to 5% at the very narrow, sharp tip of the upside-down investment pyramid, with the high expectation of losses and the aim of 5-fold returns in 5 to 10 years. There, I said it. Most financial advisors won't talk to you in these terms when discussing asset allocation, because if they start citing specific apportionments and percentages, you would be able to hold them accountable for what goes wrong in your account. Most advisors want to avoid that kind of scrutiny. Millions of people have retirement accounts that are falling farther behind their COLA every day, forcing them to give up steak and settle for hamburger, and maybe dog food next, as John Williams put it. See Chapter 6. They face horrendous losses in the next market crash unless they can learn ways to use asset allocation to their advantage, to reduce downside risks and narrow the range of outcomes in their accounts. and it bears reiterating that another next market crash will come eventually. Chances are your Wall Street advisor has failed you on this front, and my goal is to empower you to fix this flaw yourself. You need a clear-cut way to assess your asset allocation, gauge how much risk you are taking on, and figure out whether your advisors are leading you to ruin. My CHIP score is the answer, and in the next and final chapter of this book, you will learn many of its secrets.